Looking to kick this week off in the green. 30 minutes until the start of trading. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, Electronic Arts agrees to go private in a deal that values the company at $55 billion. It's the largest LBO on record.
Gold surges to a new record as a government shutdown looms. U.S. gold reserves surpass $1 trillion in value.
And they're marked right now at about $11 billion. A CEO contender, Citi's head of banking, Vis Raghavan, emerges as a potential successor to Jane Fraser. We'll talk about that.
A lot to talk about. I don't know what this means about where we're in this cycle. The fact we just had a $55 billion leverage buyout, a take private of Electronic Arts. Matt mentioned it, the biggest leverage buyout ever. So it puts it at $210 a share. We're not quite there yet, up 5.3%, Matt. My favorite fact to this is the high water mark before was a Texas utility company leverage buyout in 2007. That eventually went on to go bankrupt.
Well, that's a bad sign, but very
right.
Different industry. We're also watching defense stocks. They're moving after a report that the Pentagon is asking missile suppliers to double production rates, a tall task for production of missiles that can take up to 2 years to assemble, Dani. You can see that we're looking at big defense movers throughout the space. And later on in the show, I'm going to ask venture capitalist Tim Draper what he thinks about investing in defense.
Stick around for that conversation happening in about an hour and 45 minutes time. Let's turn back to our top story this morning. The EA deal, the biggest leverage buyout on record. Let's discuss it with Bloomberg Tech co-host Caroline Hyde. Caroline, it's punchy $55 billion for video game maker.
And not even got Battlefield 6 out yet. This is what they're betting on, future success. Look, this is a company that is all about IP. This is certainly what the CEO is trying to tell its workforce already. He sent out a note to employees. But this is about their strength not only in shooter games, such as Battlefield 6, that comes out October the 10th, but also the sports dynasty really that they're showing, the fact that they're really into soccer but also NHL and the like. This is able to withstand perhaps some of the macro headwinds, some of the offset that, everyone's turned to free-to-play games. Everyone's on Roblox, everyone's using Fortnite. How have these studios been able to withstand that? This leverage buyout comes at an idea that Silver Lake, but closely focused on some of the PIF funds, the Saudi money. They are experienced when it comes to gaming. They understand what it's necessary. And basically, this is a company that wants to come out of the eye of the storm when it comes to quarterly reporting and just get down and start being a bit more creative, a little bit more innovative without having to report on a quarterly number. But the numbers are eye-popping. If you're thinking about this from versus EBITDA, this premium is huge in comparison to, say, what an Activision was bought for by Microsoft.
I never thought being a fan of first-person shooters would make me feel old, right? But I guess the kids aren't really into that anymore. All right, so what do we know about the details? Who's behind this LBO? Which banks are financing it? Dani already gave us a share price, I think $210 a piece, right?
Exactly, and maybe there could be others that would come into play. Maybe feeling if Battlefield 6 does end up being a roaring success, you could have some competing offers here. But clearly the board has recommended this particular offer, $210 per share. As we know, Silver Lake Management, which we keep talking about at the moment because they're obviously one of the players within TikTok, they're looking to be involved, as is Saudi Arabia's, as I mentioned, public investment fund. Interestingly, of course, Jared Kushner's Affinity Partners, which has also got money from the Middle East, he's looking to be a player. Of course, close relationship with the president, so maybe that eases some of any regulatory concerns that might be coming to play with foreign ownership. But then you've also got the idea that JP Morgan's going to be here helping with the facility in terms of the debt load here. And this is going to be an enormous amount of debt that they're going to be taking on, but this is one that people are desperate to get in on. Just think about Oracle's bond sale at the moment. People want to be able to buy in on these sorts of debt mounds. We're seeing about this LBO more broadly that this is a willingness to get in to yield more and different types of asset classes. So I think JP Morgan's the main bank behind this.
It speaks to just how much money is in the system right now.
Yes.
But Caroline, elsewhere, it's been a really good month for tech, despite some of the headwinds coming out. We had another one, some excellent reporting from the team that Huawei is going to double their chip output, obviously trying to have a direct threat to NVIDIA. Yeah. It's not a new story, but how is it evoluting?
Well, the evolution here is really about getting the cadence at which they're going to be able to manufacture. They're trying to persuade the market. More broadly, they're trying to persuade Alibaba, Tencent, and those that have depended on at least 1 million GPUs, H20s, coming from NVIDIA in 2025. They're saying, look, we're going to ramp up, we're going to double in 2026. We've got you. All those bottlenecks that you're seeing, all the concerns that basically they can't really manufacture these sophisticated chips in China at the rapid scale that, say, an NVIDIA can or a TSMC can, because SMIC and the others that they depend on, it's really hard to manufacture these sorts of chips. They haven't got as powerful individual chips. I think Bernstein out there saying the next iteration of the Ascend is going to only be about 6% in terms of power versus the new GPU coming out from NVIDIA. So what they have to do is have very innovative way of basically casing it. And this is then coming to more broadly then how you manufacture that, what sort of hit rate you get. And basically you don't make as many good chips each time that you're iterating. And so they have to bake in the fact that a lot of them aren't going to work as they are meant to. But Ascend is meant to be coming on tap. We've got 1.6 million maybe being promised for the next year. So this is a big scale up coming from Huawei, and actually being far more public in their disclosures than we've ever seen before. So really trying to show Eddie Zhu that I've got you here, China. We can be there for the supply chain.
All right, it is a fascinating rivalry that's shaping up there. Caroline Hyde co-anchors Bloomberg Tech. That airs at 11 o'clock with Ed Ludlow, and they'll be covering all of these stories and more at that point. I want to get, though, to a very old and untech story. Gold is worth well over $3,800 a troy ounce, and that, by the way, values our United States of America gold reserves at over $1 trillion if we were to mark them to market. The interesting thing is that they're marked at like $42 an ounce, so only $11 billion in total. Let's talk about that with Bloomberg Managing Editor for Commodities, Simon Casey. I love a good gold bug and a conspiracy theory and like the idea that we could, like if we marked these reserves to market, Treasury could have another $990 billion.
Yeah, click of the fingers. Not as simple as that, unfortunately. It would require legislation through Congress. It's a rather controversial idea, to say the least, a bit of a fringe idea. It gained traction, if you remember, back in February, in the early days of the Trump's inauguration, following the weeks that followed, and lots of ideas being put around how to fix the nation's finances. It's still a fringe idea. Scott Bessent triggered a lot of speculation back in February. I think he talked about looking at various ways to re-engineer the U.S. balance sheet.
He wanted to monetize the asset side.
That was the phrase, right. He walked back those comments a little bit in the face of a lot of speculation from the gold bugs. The gold bugs are always there.
I'm so upset we haven't gone into Fort Knox and done an audit of the gold.
Yeah, is it even there?
Never happened. Is it even there? I'm into the conspiracy theories. We got to go in there, Simon.
I'll be right there with you. I mean, this is something that Trump sort of fueled a few months ago as well. I think he put out a tweet saying we should go there and find out. I mean, I think it's there. It'd be a big story.
That would be a huge story if it wasn't there. Elsewhere, just in the gold sector and in gold miners, a lot of different C-suite moves between Newmont and Barrick. I'm guessing they're not related, but what's going on there?
Well, the Newmont thing seems very orderly. It's a retirement, an internal promotion, sort of succession planning going on. The really interesting one is Barrick. Mark Bristow, he's been there for 7 years. He's a rare case of a CEO who was acquired along with his company, and he rose to the top spot as a result of that merger. He's a very, very well-known character inside the mining industry, very vociferous. He's been on Bloomberg TV many times, talking often very critically about the industry and how it doesn't always capture the value from gold. This is a bit of an abrupt announcement. His replacement is on an interim basis, an internal promotion, but the company's also saying they're running a full process with a recruitment firm, a headhunting firm. So who knows who the final full-time appointment will be? But that's a bit of a shock, that one. And coming on the same day, we have record gold prices, of course.
Yeah, I mean, up 80% over the last 12 months. I'm looking at a chart here, and if you look at Barrick, it's only up like 50% in over 5 years. Newmont also isn't doing great, but their competitors have doubled, tripled, even quadrupled.
Yeah. Some of these bigger companies have run into big operational problems, particularly with Barrick. They've got very serious issue in Mali, where the junta there has tried to seize control of this massive mining complex. They've imprisoned some of their employees. So Barrick's been dealing with that. But mining is a difficult business, but as you point out, the last several years, the equities just have not kept pace with the metal. So it really calls into question the fundamental case of why would you want to buy these shares when you could just buy an ETF, buy the physical gold itself?
And people surely have. Simon, thank you so much for joining us. That's Bloomberg's Simon Casey. All right, we're 20 minutes from the cash equity open. Futures look to rebound after the first down week last week in about a month. By the way, this is the S&P 500's best September since 2013. And we started this month. How did we start it? Basically saying September is usually horrible.
Yeah, we showed the heat map and we were like, oh, over the last 20 years, it's been one of the worst months, if not the worst month. Yeah.
And everyone was like, summer's over. Everyone's back at their desk. There's so many risks between tariffs and the Fed. By the way, all those risks still exist. But we keep pushing things higher to new records.
And we're going to some really positive seasonality. Like October and November are traditionally good months. So, take that for whatever it's worth. Coming up, Citi's investment banking head has emerged as a candidate to lead the bank after Jane Fraser has her turn. More on that next. This is Bloomberg Open Interest. Let's get out of high interest. Look what's making headlines around the world. Chinese President Xi Jinping is pushing for the U.S. to change a decades-old phrase describing its stance on Taiwan independence. Sources tell Bloomberg China has asked the Trump administration to officially declare that it opposes Taiwanese independence. Stronger language than the previous statement that the U.S. officials do not support Taiwan's independence. It's a subtle but huge difference. Let's get to company news. Astrazeneca plans to list regular shares on the New York Stock Exchange to attract more investors. A direct listing of Astra's ordinary shares will replace the existing ADRs on the NASDAQ. AstraZeneca is the biggest drug maker in the UK, makes almost half of its revenue, though, here in the US. It does plan to keep its UK headquarters, but who wants to list in London? Citi investment banking head Vis Raghavan has emerged as a potential candidate to succeed the current CEO, Jane Fraser. Raghavan has energized the division since his arrival last year, with the bank scaling the M&A advisory ranking and displacing rivals on recent deals. And this is something I think that a lot of investors and also probably viewers who work at Citi are very interested in, Dani.
Definitely. Assuming the ones on his floor are currently watching. Let's stay on that story and bring in Bloomberg's chief Wall Street correspondent, Sri Natarajan. Sri, it's also interesting that this is an individual who came from JP Morgan as well, somewhere that's had maybe some issue keeping top talent because of succession planning. What do we know about him and the likelihood that he would be a successor to Jane Fraser?
Well, let's start with the three most important factoids about him. Vis Raghavan is a cricket fanatic, which puts him high up in my list.
Of course, a necessary quality.
Has a fondness for Italian ties and has purchased a penthouse in New York that was previously rented by Bad Bunny. So let's get those three important facts out of the way. Now, Vis Raghavan has come to Citigroup at a very important moment. The bank has been struggling. End of 2023 was perhaps the low point of Citigroup. Shortly after that, CEO Jane Fraser had to come out and announce this massive restructuring that involved cutting 20,000 jobs. But about 2 years into this process, there are clear signs of turnaround. Citigroup is the best performing big US bank stock this year. That's important. Even on the investment banking side, the very particular mandate that Vis Raghavan has shown signs of improvement. It has already gone ahead of Bank of America for the full year numbers. If you were to look at financial advisory fee, analysts are estimating that Citigroup will finish number 4. But really, this is not about the number 4 and number 5 spot. For Vis Raghavan to be really successful, he has to be able to prove to Citi's management, to its board, to its CEO, that he can lift this bank into the top 3. And that's going to be a very difficult challenge because the Goldman Sachs, JP Morgan, and Morgan Stanley, that trio has a really solid advantage. So the task ahead is difficult, but there have been early signs that sound very promising for Citigroup.
What works to Citi's advantage? I mean, they must be one of the most international banks out there.
They are one of the most international banks. They're, of course, paring back some of what they believe are not core to them, operations that are not core to their mission, cutting back on some of their international banking operations per se, but focusing more on the commercial banking side, right? Focusing on this wealth management and commercial investment bank side and saying, if we can focus on this, lift our return on equities, which, for this year perhaps is still in the single digits. They need to be much better than that, but they're slowly working towards that. And if Jane Fraser's turnaround continues on this track, analysts will be happy with where they are headed, not necessarily where they are right now.
Can I ask you just about succession planning? One of the things I never fully understand is you have this person coming in, has done a great job for the bank and saying maybe a potential successor to Jane Fraser. I think they're literally the same exact age. So how would that work if you have two people who are, or a person who's a rising star, but she's not necessarily going to leave anytime soon?
I'll one-up you on that. Not just almost literally the same age. I think Vis Raghavan is about 6 months older than Jane Fraser. So most certainly the biological clock is not favoring him. Also, don't forget the fact that Jane Fraser is about 4 years into her tenure as the CEO. And while the average tenure on the S&P 500 tends to be about 6 to 7 to 8 years for CEOs, that's not necessarily the case in the banking world, especially when the CEOs had a good run. So if Jane Fraser can continue this Citigroup turnaround story, there is no reason she would have to leave in the next year or 2 or 3. And if that's the case, then yes, it becomes harder to see how a Vis Raghavan becomes the next CEO. The counterpoint to that is 60 is the new 50.
Right. Well, and she still is underperforming Jane Fraser. I mean, there's no bank on Wall Street that's done worse over the past 5 years other than Bank America.
And to that, she will say there's no bank on Wall Street that's done better than Citigroup in the last year. And that's important.
Well, 1 year, right? I'd take a longer term. As an investor, I would take a longer term view, probably as an employee as well.
So see where the story is headed, not where it is right now, is what Citigroup is going to tell you.
All right, Sri Natarajan, go where the puck is going. He is Bloomberg's chief Wall Street correspondent covering this story for us. We'll get a quick check on futures ahead of the opening bell. We're looking at gains across the board, 0.5% on the S&P 500, and we're getting results in terms of earnings. And you and I were in the green room earlier, Dani, for surveillance and talking to a couple of strategists, talking with Max, talking with Jonathan, and they were saying it's really all about earnings, right? And we have great earnings news out from Carnival, raising their full year outlook.
Yeah, they're raising their full year outlook better than the guide that was in June by $235 million. Shares are up, you can see, nearly 4%. Cruise keeps surprising to the upside, though. This is one part of the consumer economy that still has been so strong. But how much of it is just about, okay, consumers are happy, they want to keep traveling, versus the cruise lines really trying to shift to luxury and capturing the upper income cohort that is making these results continue to be strong? Is
that what's happening? I mean, if you're a rich person, do you go on a Carnival cruise? I mean, I guess the results point to some of that at least happening, and we do see the shares up 4%. Next hour, we're going to hear from Norwegian Cruise Line CEO Harry Sommer. We'll ask him if that's the case. They've been adding to their luxury offerings. They have. They have a new maiden voyage ship happening that is a luxury ship by all accounts. He's going to ring the opening bell at the New York Stock Exchange as well, so investors will notice. We're also going to get RBC's Lori Calvasina on the high bar for earnings as Goldman strategists turn bullish on stocks globally. This is Bloomberg Open Interest.
Goldman Sachs strategists are telling clients to buy the dip through the end of the year. The team is overweight on stocks over a 3-month horizon, citing earnings growth and global fiscal policy easing. Earlier this month, Goldman raised its year-end S&P 500 price target to 6,800. Joining us now is RBC head of U.S. equity strategy, Lori Calvasina. And Lori, I mean, you have maybe been more reserved, not bearish by any means, but more reserved in some of the stuff that you have been seeing. We're about to book the best September since 2013, after we came in saying that the seasonality was horrible. Can you keep buying dips, or is it just about staying where you are?
I think this is a really weird market. I don't necessarily disagree with the buy the dip strategy. We actually put out a target of 7,100 for the second half of 2026, really just to kind of flag how our models are trending for next year. Some of our models are on a 12-month forward basis, so it's not quite a year-end target. But I do think that we've got a good earnings setup for next year. I think there's, a little bit of an issue on valuation in the here and now. And what I talked about a lot last week in my meetings, I was in in the UK, and frankly, a lot of people over there are a bit more reserved than what we're seeing in the US. What I've noticed is that when I look at my PE charts, and just the last month and a half or so, we're creeping up to these new highs on the S&P, but I'm not seeing any multiple expansion. And so it looks like whether you're looking at S&P top 10, S&P 500 market cap weighted, NASDAQ 100, pick your own adventure. You can do equal weighted or cap weighted there. They're not making new highs. They're up around levels that have marked the most recent post-tech bubble ceiling, and they're unable to break through. And so I think that's why when I see this market, it feels like it's creeping up to new highs, not exploding to new highs, even though everyone's getting excited about the price levels.
So we essentially need to have a continued earnings expansion in order to have price appreciation. I'm also interested in, I was listening to you with Nathan Hager this morning on Bloomberg Radio, and you've done some work on inflation, because we're starting to realize that 3% is really what the central bank is focused on, right? They talk a big game about 2%, but they never, ever, ever go down there. So do we see gold breaking out to new highs? Do we buy equities as well to counter inflation?
So, the reason I sort of got focused on that, it was sort of like mid to late August. I'd been talking to Chris Looney, who's our gold strategist. We were sort of comparing notes on kind of what's driving his market versus what's driving mine. And that was right when we were starting to see all the euphoria on small caps start to break out. And I thought back to my early small cap days where I remember people used to say small caps are inflationary. And so I did this.
Or an inflation hedge.
Yeah. And basically, small caps were kind of born in the 70s. That was when it was a really hot asset class. And then that was really, sort of inflation was obviously a major issue back then. So I dusted off a bunch of charts, built some new ones, just looking at things like equity allocation on the flow of funds data. They call it something now besides flow of funds, apparently, but looking at that data set and comparing it to inflation rates over time. And it's kind of broken down in recent years, but you could see that equity allocations would go up when inflation was moving up. And then I did some work on small cap. I think I looked at ISM prices paid, which my economists tell me is a good leading indicator for goods inflation. And you had seen some relationships there as well between small cap performance and just that particular inflation indicator. And there had been some we had used in the past. But again, a lot of these have broken down in recent years. So we wondered if part of what was going on in August was, kind of people, frankly, looking, for clues on what to do, trying to make sense of this inflation environment and kind of having some of that past history influence decision making.
All right. Fascinating stuff. Lori, we're going to keep you with us. Lori Calvasina from RBC is going to stay with us through the market open as futures point higher. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on futures. We're higher across the board. It's not a new month yet, but October does look good seasonally, and we're almost there. S&P futures up 1/3%, a little bit more than that. NASDAQ futures up 0.5%, and Russell futures gaining even more. We're excited, more excited than usual, about the New York Stock Exchange bell ringing ceremony today, because Harry Sommer is ringing the bell, CEO of Norwegian Cruise Lines, and he's going to be on with us in 1 hour's time. So definitely want to join for that. After Carnival Cruises had some great results, Norwegian hasn't done as well as Royal Caribbean or Carnival in terms of stock performance, but they have a new ship apparently coming in, and we're going to take a look at that and talk about the luxury aspect of the business. ArcBest ringing the bell down at the NASDAQ. That stock, those people are happy because it's more than doubled as well over the last 5 years. So they're making money. And Dani, it looks like defense companies also are doing well this morning. What are you watching?
Yeah, I'm watching basically all of the defense stocks this morning. They're all moving to the upside. There's a report from the Wall Street Journal that the Pentagon is asking all of its missile suppliers to double, even quadruple production rates in some cases. It's a really tall task, considering that doing that takes a lot of time, up to 2 years to assemble, and a lot of money. It's not clear that these companies have the commitment from the Pentagon for that money, Matt, but on the assumption they will, we're up by as much as 2.5% for RTX.
All right, we're talking also today about the largest LBO in the history of the universe. Game maker Electronic Arts is going private in a leveraged buyout at $210 a share. That is, what, is it a $50 billion? The big
55.
number. $55 billion LBO, the biggest video game deal since Microsoft bought Activision, and as we've been talking about, the biggest LBO. We are back with RBC head of U.S. equity strategy, Lori Calvasina, and there's so much going on that I don't think we need to talk to you about LBOs. I want to know about the government shutdown. We haven't really mentioned it much, but aren't we all assuming this is going to happen? I mean, nobody seems to care on either side of the aisle. So does that matter for stocks?
Look, I think that the unfortunate reality is, and I've been doing this in some form or another for over 25 years, and whenever this stuff comes up, you go back and you look at the history and you realize that a lot of these shutdowns, while there have been a few that have been lengthy, most of these, and I actually updated my analysis this weekend, redid some of my work on this.
This is what Lori Calvasina does on the weekend.
I'll be honest with you, I got very little sleep Saturday night. Part was jet lag and part I just decided I needed to rebuild all this stuff. But there's a lot of 1 days and 3 days on the page, and so you realize a lot of these things are pretty fleeting. The other thing is, if you go and look at the performance of stocks on the days in which the government is actually shut, there's a lot of it's kind of mixed and mild. So back in the 70s, we tended to see declines. More recently, we've seen a lot of green on the chart, but the percentage gains are not very big. Now, you can go back, and I actually did this Saturday night, and kind of break out. Oh my God, I sound like the biggest nerd, but you go back and you can sort of look at the different decades, and we plotted the different shutdowns, and you can see in the 70s, these shutdowns would happen in the middle of these really nasty market declines. Fast forward to the 80s, you have to look really, really hard to find the market dips, and they're all 1.5% to 4.5%. And then we didn't really have any in the 2000s. We had a couple in the 90s, and they look completely different. So as someone who's supposed to forecast markets and go out and tell people do X, Y, and Z because of this event, it's every decade is completely different, kind of choose your own adventure. And this decade, frankly, just seems to be very, very different.
A wild Saturday night, Lori. Just an absolutely crazy Saturday night.
The idea is that gridlock is good, right?
But
and that's the ultimate gridlock if the government shut down.
Wait, but is this time different, though? Bob Elliott has been talking about this, because this time you have a president who's saying, we're going to lay off hundreds of federal workers if we shut down.
Essentially fire
everyone. Yeah. So there could be a bigger economic impact this time, maybe impacts markets more?
Well, look, I think one of the things we learned from the spring, right, with sort of the whole Doge effort, was that this idea that, government jobs are going to be this tailwind to the labor market. We've had plenty of time to digest the reality that that's just not in place anymore, right? So this could be episodic. But I do think, right, we're all sort of on tenterhooks looking at the labor market data anyway, right? So maybe, yes, maybe there's a little bit more relevance on that front, but I think this is an issue we're already quite focused on. I do think that, you always want to be careful of just taking the past and say it's going to automatically work this time around. But I will tell you, I'm worked up about, the possibility of a pullback at the end of this year, between now and year end. And even I have a hard time, sort of getting too nervous about this particular one.
I want to ask about something completely different, and that is Dani's been telling me for weeks about the lack of supply of stocks in public markets, and it takes so long for anything to get through this thick skull of mine. But I actually saw Shonali Bassick, now at ICAP, tweeting out the same thing over the weekend. How much does that dearth of supply drive up the price in general? Is 25 not a very high PE, considering the fact that we only have, half the stocks that we had in the 90s?
Since the late 90s, yeah.
Yeah, look, I kind of, from an S&P 500 perspective, I kind of fade this issue. I mean, the fact is multiples are hitting ceilings that have been important ceilings in the past, and even the recent high on valuation isn't that far below the tech bubble high, at least on the particular metrics that we use. And the S&P 500 has plenty of supply. I don't think that, we're struggling to find companies. Right? You can always pull some of the smaller or medium-sized stuff up. Where the lack of supply, I think, has been really relevant in my day-to-day is talking to my small-cap portfolio managers. Because remember, I'm an old small-cap strategist. And we don't do this work anymore, but in the past, we used to do a lot of work on, sort of crowded positions in long-only small and mid-cap funds. And it was a really funny exercise because I would take the list of the top 25 names and show them to the small-cap PMs, and they would be horrified because you talk to a growth guy who owns 17 out of the 25 names, and he's like, but I'm a stock picker, and I like to differentiate. And the reality is that when you have a lack of supply in that part of the market, it causes crowding. So I think that it could be, a contributing factor to sort of those crowding dynamics, certain stocks getting more elevated, people having to tolerate valuations they don't want to in the small cap space. I don't really see that being a problem in the big cap space.
Well, we did have a huge big cap take private. Matt was talking about it and didn't want to ask you about LBOs, but I do, because it is the largest leveraged buyout, $55 billion. JP Morgan supplying $20 billion in debt for this. There's so much appetite for debt financing for these big type of deals. What does it say about where we are at the cycle? At the same time that we're having a discussion about the Fed cutting, there's so much liquidity for this type of public market deal?
Well, I think what's interesting to me is everyone was going bonkers about the idea that like M&A and all this deal activity was going to pick up this year, and we haven't really seen it for one reason or another. So, you know, when we do sort of see transactions coming in, I kind of think about it from that perspective. Are certain things not getting done, so markets are sort of shifting to other things.
Okay, Lori, this has been so excellent. Thank you for joining us. You have to join us again after one of your crazy Saturday nights to tell us what you come up with next.
Crunching data.
RBC's Lori Calvasina. Let's get you a check on equity markets about 8 minutes into your trading day. And we are moving higher this morning by about 1/3%. That follows the first down week for this market in about a month, but we are set for the best September since 2013. NVIDIA leading us higher despite the fact we had a story early this morning from the tech team at Bloomberg saying Huawei is looking at doubling its output of AI chips. That seemingly not threatening NVIDIA. It's NVIDIA, Broadcom, Tesla, Meta, Alphabet. Goes this whole story of should we have a different Mag 7 that includes something like Broadcom. To the downside, what's leading us down is Apple down about 0.75%. Intel down a punchy 4.4%, but that comes after a huge run last week. Exxon, a lot of the energy players down with oil prices down this morning. You'll also see that on our sector board. The fact oil is down more than 1%. OPEC looking at pushing up their output. So there you go, energy at the bottom of the pile, down 1.3%. What's at the highest? I showed you NVIDIA, so of course Infotech, that is at the highest at 0.8%, followed by industrials and consumer discretionary, Matt.
All right, coming up, sluggish growth is forcing video game studios to consolidate or go private. We've been talking about the EA LBO. We'll discuss that with gamer and Bloomberg Tech co-host Ed Ludlow next. This is Open Interest.
Let's look at some top calls this morning. Some of the analyst upgrades and downgrades. First up, Morgan Stanley downgrades Novo Nordisk to underweight. They see slower weight loss, prescription growth in the U.S., and competitive pressures driving downside risk. Shares down 2.5%. Wells Fargo, they're downgrading Western Alliance to underweight. They say that the bank won't benefit from interest rate cuts until next year. Shares down almost 1%. Finally, Jefferies, they raised their price target on Alibaba to $230. They point to optimism over the company's cloud and AI business, and shares of Alibaba up 5% after already doubling this year, Matt.
All right, fascinating group of movers and shakers there. Let's get to Electronic Arts. It's going private in the largest leverage buyout on record. A group of investors are paying $210 a share in cash, valuing the company at $55 billion. Bloomberg Tech co-host Ed Ludlow is not in San Francisco. He visits us here at the desk in New York, and we're so glad to have you here, Ed, because not only do you have a wealth of knowledge on this sector, but you also are personally, you have your own heartfelt stake in EA.
Yeah, like, you know, this speaks to why we've got the biggest leverage buyout of all time. Like, when I was a kid, I had this deal with my parents that if I gave up 4 weeks of allowance, pocket money for British people, on a Friday night we would go to Game or Woolworths or WH Smith and buy a disc. That business model just doesn't exist anymore. You know, gamers around the world want something that's largely free to play with in-game mods, right, that you buy. And EA has all this intellectual property that it just doesn't have a footprint in those other worlds, esport, franchising into movie, TV, and film, like some of the other big names out there do. And it's a continuation of something that Saudi Arabia has been doing for years. You guys mentioned about JP Morgan and the debt, and the details are important. But everyone's overlooking that the PIF or PIF already had 10% of this company anyway. You know, they're sticking with gaming.
And we should
time.
point out who's going to take. We're talking about the PIF. We're talking about Silver Lake.
Yes.
Who else is? Who are the buyers? Because when you tell me LBO, I think about management, but that's not what this is.
Yeah, and also, you know, when you think about LBO, you think about an environment or a company that is seeing some kind of financial pressure, like slowing growth, which is absolutely true of EA and the video games industry at large. I would focus very much on the public investment fund side of this story. In this letter that Andrew Wilson, the CEO of EA, sent to staff, and he's continuing as CEO, by the way, he uses the words sports and entertainment a lot. And I think that they basically see the public investment fund and what Saudi Arabia is trying to do more broadly as access to markets that they want to be in, but they are not currently in.
Last time we had a deal that even rivaled the size of an LBO, I was talking to Matt about this, was 2007, a completely different company, a Texas utility company that went on to go bankrupt.
Right.
Maybe it's a sign of the times, but what does it say that there is so much demand for debt financing when we are talking about concerns about consumers, whether they're still spending money? And again, it's a video game company. It's not necessarily like one of these flashy AI newfangled companies that this is happening for.
Yeah, I mean, the parallel I draw, though it's tenuous link, is like what Musk is doing with XAI and some of the debt financing of GPUs and infrastructure. No one seems worried about that. In fact, like every time we have like these market strategists on Bloomberg Tech, I ask them like, do you guys check out the debt paragraph and like read about it? How worried are you about it? And I don't cover the Fed or this macro stuff, but everyone seems pretty sanguine right now that this is the liquidity for all of these companies is not an issue. Whether they roll some of this debt over to EA, which is currently free cash flow positive, like it's worth checking out in the terminal. Like it's not a terrible business. I find that interesting for sure.
I want to ask you about, just in general, we seem for a few years to only care about 7 stocks.
Yeah.
Right? And now that sort of Mag 7 moniker is kind of going out of fashion because you've got so many other big stocks that you and Caroline cover on Bloomberg Tech, you know, Broadcom, Palantir, that are, you know, at least growing at the same pace, if not quicker. So
I don't have the column in front of me, but shout out Ryan Blastelica on the equities team. That guy's awesome. But what did he call it? The 10 AI of Gen AI? And some of these other ones.
There are some that he maybe made up.
But you know, the point is, right, is that a lot of the Mag 7 names were tied to the first phase of what we saw, massive infrastructure investment, largely related to training of AI. The revenue generation is on software, like people using that work to make more attractive software products, and that's why Palantir is in there. But Broadcom is also muscling in a little bit on NVIDIA's territory, offering custom chips to anyone that will buy them, and that anyone is OpenAI.
It's grade 8, golden dozen, 10 AI of Gen AI, and the takeaway is obviously if it doesn't sound catchy, it could never be a moniker for this market.
But you know, also like, you know, the investors are more discerning. Like we've learned this hard lesson over 2 years. Micron is a great example of that. 2 years ago, Matt, we talked about high bandwidth memory, and actually the stock's performance since, like Wall Street was paying attention for sure. And I don't know that Micron's mentioned in any of those groups.
We talk about being discerning, yet Oracle has been on this massive run and getting all this financing for production facilities that it doesn't yet have, and taking out massive amounts of debt. Manny Roman of PIMCO was on Surveillance earlier basically saying, we don't know what the future is going to look like, and you have to be humble about the errors that you might get going forward. Maybe the closest you can kind of bet on is 6 months ahead. Is this not an investor base that's betting on years and years of spending to come that we don't know if it will actually come to fruition?
So when a data center gets built, let's understand who's building it, who's financing it, and who's going to use it. And the only question that we as Bloomberg television anchors, in my opinion, right, should use from this point is who is writing checks that they cannot cash? Is it OpenAI who leases the capacity? Is it the energy industry or the utilities because they don't have the ability to support this? Keep asking that question because I you know, in the marketplace, people are starting to ask that, even if they're not worried about the debt portion.
Right, and as we play this sort of stock market shell game, is Huawei catching up to?
Right, Nvidia's up like something % this morning, right? Anyway, in spite of that.
Yeah, in spite of that Huawei story, right now we're looking at Nvidia shares that are gaining 2% and almost 3%. We should say Oracle is up today as well, but it's still trading at like 285. So it hasn't been this low since the beginning of September. It had a rough week. Ed, great having you here. Sure. We could talk for hours, but you're going to do that, at least for 1 hour at 11 o'clock with Caroline Hyde.
They let me.
We look forward to Bloomberg Tech. And we're going to talk when we come back about something that's decidedly non-tech.
Decidedly non-tech.
Unrelated
indeed.
to AI.
Yeah, literally quite physical because it's big boats. Consumers are taking cruises. Carnival says nearly half of 2026 is already booked. We're going to have more on their strong earnings. But why is the stock falling 2 1/3%? That's coming up next on Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on stocks. Just about 20 minutes into the trading session, the S&P 500 trading up 0.4% at 666.9, 6670 now. The Nasdaq right now up about 0.9%, 24,713. So you can see tech stocks doing considerably better than the rest of the S&P. That as evidenced by NVIDIA, up 2.7%. That's the big mover, and that's a big lift on the tech-heavy indexes. Oracle was up, but now has turned down. It's only 0.3%, but that means if we close in the red, it'll be the 5th session in a row that Oracle trades down. EA, obviously the biggest leverage buyout ever. Shares at 210 in the buyout, so we have a ways to go to get there. That's lifting Take-Two as well. And then the cruise lines are both down. We're going to talk to the CEO of Norwegian Cruise Lines. Harry Sommer is going to join us in just about 30 minutes' time. But Carnival came out and lifted its full-year guidance, and yet, Dani, shares are off 2%.
Shares are off 2%, but it's probably worth emphasizing that they're up 22% year to date. Let's get more on Carnival. We're joined now by Bloomberg breaking news editor Guillermo Molero. Guillermo, is this just a case of the bar being incredibly high for Carnival?
That bar is definitely very high. I mean, the shares have been ripping all year, like you've been saying, especially since April. But, you know, the company has just raised its guidance for yields, raised its guidance for adjusted net income. They're looking at a really strong finish to the year, especially after a really strong summer season.
They've underperformed, over a longer period of time, Royal Caribbean, and so has Norwegian. What's the play in this cruise industry? Dani was mentioning that higher end consumers may be looking to get in on the action. So are they buying new boats? Are they upfitting their existing fleet? How are they attracting luxury buyers?
Well, one of the big things that Carnival has done this quarter, at least started offering this quarter, is their new Celebration Key, which is one of those private island offerings. Other cruise lines have started to offer these sorts of products that can really differentiate themselves. And I think that's what Carnival is trying to do, is really bring in consumers that are expecting a little bit more, especially from a carrier that might have that broad-based appeal. I think they will also want to try and bring in customers that can spend a little bit more. And they look to, be doing a little bit of that just now.
These undertakings, I'm assuming, are incredibly expensive to have an island, have new boats, fit them out, make them a luxury offering. What does it look like the return on some of these investments that Carnival and others have doing? Has it been paying off to have this shift into creating this ecosystem where everyone is forced to just spend money at Carnival and not go ashore somewhere and spend money at an actual restaurant? Yeah,
definitely. And I think, like you were saying there, it's about keeping the money in the ecosystem, and I think that eventually will have a really big return for them. The capital expenditures, I think, just for the next quarter look to be about $1 billion, so it's definitely an expensive undertaking, and they're doing a lot of balance sheet reworking to try to make sure that they can, keep the company's balances afloat while they're doing that. But in the long term, I think the goal is to keep all of the money inside so that every aspect of the vacation, the room, the amenities on board, the private island that they'll sail to, and the money that they'll spend there, everything is going to stay in that Carnival bubble, and eventually, hopefully, that'll drive up returns even more.
All right, Guillermo, great to have you on. Thanks so much for joining us with this story. Carnival Cruise Lines raising its guidance, but the shares falling 2%. We're going to have more on the cruise industry in the next hour. As I've been telling you, Norwegian Cruise Lines CEO Harry Sommer is going to join us. He just rang the bell at the New York Stock Exchange. They've got a new boat coming in that we're going to talk about. Apparently, some of these cruise lines have racetracks on board. On Norwegian Bliss, cruise passengers can drive go-karts on a 2-story racetrack. That might be enough to sell me, actually.
I would be terrified. I don't want to drive a race car on top of, like, in the middle of the ocean.
I mean, the more danger, the better, right?
I have a lead foot. What if I just, fully...
But it's water. You'll be okay.
I don't think that's how it
still
works,
could be pretty dangerous. Still, check on stocks. We'll talk to Harry about this because I'm sure they're not endangering any customers' lives. Quick check on stocks right now. We are up across the board. Well, no, the Russell 2000 is now in the red. Coming up next hour, other than that, we're going to talk the world of private credit with New Mountain Capital's Laura Holson. My old buddy Tim Draper is going to join us to talk about AI and reality TV. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger, looking to end November. What month are we? September on a strong foot as we head to the next month, the best September since 2013.
November's also a good month for stocks.
Meaningless.
October, time is a flat circle, as Katie Greifeld says. Coming up, Shutdown, Showdown. President Trump and Democratic leaders are set to meet on a budget impasse a day before federal funding expires.
Electronic Arts agrees to go private in a deal that values the company at $55 billion. It's the largest leveraged buyout on record.
And on the hunt for the next big thing, we'll hear from billionaire venture capitalist Tim Draper later this hour. I'm looking forward to that talk. I've known Tim for 45 years.
Yeah, and he's got a new show, I hear.
He has a new show, Meet the Drapers, but it's a fascinating family story. 3 or 4 generations of venture capital, but they've been involved in the military, they've been involved in diplomacy, the Drapers have been involved in sort of redeveloping war-torn Europe. I mean, you name it, they've done it, so I'm looking forward to the talk.
A lot to ask Tim Draper about, so stay with us for that conversation about 45 minutes time. First, Matt, some really, really strong data just breaking through. It is pending home sales coming in at a 4% rise. The estimate was a 0.4%. The prior reading was a decline of 0.4%, but that gets revised to just a decline of 0.3%. So again, the net sum, and like the housing data we've been getting all this month, Matt, is a lot stronger than expectations. A couple things going on, and that mortgages have dropped low. But one thing that's super important to note, this is pending home sales, and there have been lots of cancellations. A lot of contract cancellations have been happening. So maybe this isn't as big of a signal as it used to be. But either way, another piece of housing data that looks surprisingly strong.
All right, as mortgages, get lower, but are still above 6%. If ever there was a time we need to talk to Mike McKee,
now would be a good time.
Now would be a good time. But I'm going to just IB him. Turning our attention to the drama in D.C., President Trump will meet with top Democrats, including Chuck Schumer, this afternoon at the White House. The meeting comes as federal funding is set to expire tomorrow. Joining us from Washington is Micah Soellner, White House reporter for Bloomberg Government. Micah, great to have you on the program. What do we know about this meeting? It doesn't seem like Schumer's going to cave, right? Because the far left of his caucus won't let him do that, and clearly the Republicans aren't going to. So why bother?
Yeah, exactly. Today is anybody's guess in terms of how this is going to go. As we know, President Trump operates, on his own volition. And this meeting was actually supposed to take place last week. It got canceled. It got rescheduled right away. So it's really up in the air in terms of whether the president just wants to bring in Democrats to tell them that, that they're not going to get what they want, or there's going to be a real deal made. So we're going to have to see here. But, I wouldn't bet on anything here.
Some of the immediate impacts, Mika, because we're about to get a week of data. We have jobs data. Jobless claims comes out on Thursday before that. What can we expect to get and not get if there's a government shutdown?
Yeah, I think that one thing to look at is that the timeline is going to be really unpredictable in terms of how long a potential shutdown could be. And we're going to see a lot of impact when it comes to the federal workforce. I know that the administration is already making plans to lay off even more workers if a shutdown does happen. And we're going to see that really trickle down to, some of the workers when it comes to travel plans and TSA and things like that. So these are things to watch for.
All right, Mika, thank you so much for joining us this morning. That's Mika Soellner of Bloomberg Government. Now, a check on markets this morning, about half an hour into your trading day. We're up by 0.4% for the S&P. NASDAQ outperforms even more than that as yields drop this morning. 10-year yield down by 3 basis points. It has been the front end of the yield curve that's been creeping higher these past couple weeks, but we're doing some work to erase the losses of last week, which was the first down week in about a month's time. Some of the AI spending fatigue seemingly creeped in. We've forgotten all about that this week, and apparently we don't care about a government shutdown either. Lori Calvasina says it rarely impacts this equity market, Matt.
Yeah, I think the question is this time different because the Trump administration seems excited to use a potential shutdown as an excuse to permanently fire, a lot of federal workers, whereas previously a federal worker would be furloughed. They don't get paid during the shutdown, but they get paid when they come back. That would not be the case this time, and that could have real economic impacts.
Yeah, that's the argument that Bob Elliott has been making, saying that this time around it's going to be more volatile should we get a government shutdown because of exactly what you're saying, Matt.
All right, let's get a look at some of the single stocks moving at this hour. Shares of Carnival are fluctuating after the company boosted its adjusted net income forecast for the full year, but I've mostly seen them in the red. So off right now, 1.5%. And we're going to talk to a Norwegian Cruise Line CEO, Harry Sommer, next. These guys are trying to get more people to spend on their cruises. And Norwegian, although it's been an underperformer in terms of its stock price, has been an outperformer in terms of getting people on its boats to spend more money.
Yeah, and they're investing in more boats and newfangled things that will keep you on said boats and spending more money. Matt, we're also looking at weed stocks. Those are rallying this morning. Tilray, Canopy Growth, Aurora. President Trump posted a video on social media touting the medical benefits of hemp-derived CBD for seniors. I'm going to be honest. I watched the video and I kind of wish I could get those minutes back in my life. It was literally, it was like a weird infomercial for CBD. I thought it would be the president himself talking about it. It was actually a video compiled by someone else, another company that like promotes access to legal marijuana doing this. And it basically just talked about how there's something in your brain that like CBD benefits, and yeah, it felt like an infomercial.
But I think, Nathan Dean is our Bloomberg intelligence analyst for government affairs, and I ask him every time I talk to him about safe banking. Like at some point, the federal government has to allow money to move through the system from these weed companies. They're generating tens of billions of dollars in revenue, and now it sounds like the president is on board.
Yeah.
These stocks have been held down by that. So maybe, if the president's tweeting out promotional videos for weed products.
Yeah, I mean, it was CBD to be fair, not necessarily.
It's the lesser of the two main weed products.
Yeah, correct.
Right? Not the fun one. Keeping an eye on Netflix after President Trump posted on Truth Social that he will be imposing a 100% tariff on any and all movies that are made outside of the United States. The shares right now in Netflix are gaining. If you look across the studios, you don't really get a clear reaction to this because I don't think anyone really knows exactly how that would work.
Yeah, how would you tariff if like one scene was filmed in Norway somewhere? And it's very, and that's why when we had Trump giving these threats earlier in the year, they quickly went away because there's just this huge question as to how you would do this, although he does seem to be moving forward with furniture tariffs too, so more levies.
Maybe easier to quantify and price, but
still
it'll
hard.
be
What
interesting.
If just one like piece of one chair leg is made in China and the rest isn't?
Yeah.
That's also difficult to tariff too.
Well, we'll continue to work on that. I'm going to ask ChatGPT. Coming up, Laura Holson of New Mountain Capital on risks in the private credit market. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. Edward Eisler is closing his investment firm due to weak return, shrinking assets, and ballooning staffing costs. The Eisler Capital Multi-Strategy Fund is winding down and returning capital to investors. Clients won't be able to withdraw their money while the firm liquidates trades. Eisler is a former Goldman prodigy before starting his own hedge fund. Huawei is ramping up production of its most advanced AI chips. Sources tell Bloomberg the company plans to make about 600,000 of its marquee 910C Ascend chips next year. That's roughly double this year's level. If Huawei can hit the new targets, it would represent a technical breakthrough for the company. And two C-suite shakeups in the metals industry, specifically in gold. Barrick has appointed Mark Hill as interim CEO following the abrupt departure of Mark Bristow after nearly 7 years in the top job. And Newmont's CEO Tom Palmer is also retiring after 6 years, with that company's COO set to take over. And auto parts supplier First Brands has filed for Chapter 11. The bankruptcy follows scrutiny of its reliance on borrowing against future cash flows, drawing short sellers that included Apollo Global, Diameter Capital Partners as well. First Brands makes wipers and car filters sold at retailers like Walmart.
Stay in the world of credit, and specifically turning to private credit. PIMCO CEO Manny Roman spoke with Bloomberg TV earlier on his outlook for the asset class.
the initial condition where we are right now are such that equity markets are expensive by any measure. They may go higher because momentum is strong, and credit market are tight in some part of the spectrum. And I think that's the reality. And look, we've been in a period where things are expensive for a long time. 2005, 2006 were such period where things remain expensive and became more expensive, and then something breaks, and then all of a sudden you have a lot of work to be done.
Let's continue the conversation. I'm pleased to say joining us now is Laura Holson, Managing Director and COO of Credit at New Mountain Capital, a $55 billion alternative asset manager with private equity credit, net lease real estate, and wealth solutions platform. Laura, thank you so much for joining.
Thanks for having me.
And I would say Manny, along with the team at PIMCO, has been much more bearish, I think, on private credit and direct lending than a lot of the industry has been. Do you think that there is a real risk that, in his words, something breaks?
We don't think so. I mean, we also were not big proponents of the golden age of private credit, just like we're a little less, less proponents of the huge risks. We think that private credit is here to stay. It's a sustainable asset class with a lot of secular tailwinds.
So, but you have a lot of money looking for assets that a lot of other money on the street is looking for, right? How do you find the right places to deploy your capital?
Yeah, I would say right now we're seeing pretty good activity, even with a slightly depressed M&A backdrop. I think that private equity firms are growing, they're getting bigger, right? There's a lot of activity that they need to finance, both on new deals, but also on existing deals. So I would say we're seeing pretty good activity across the board when I think about types of deals.
Matt and I have talked about this a lot, just like the vast amounts of demand out there, that there's so much demand that every time you have an issuance on the syndicated loan side, that order book gets filled up really easily. On the private credit side as well. Does it have any impact in distorting the market when there's so much money getting put to work? Are things maybe not totally priced for the risk that they might entail because of that?
Yeah, I mean, it's certainly like everything else, right? We have this supply-demand imbalance at times. Over longer periods, it obviously evens out. Right now, again, given the slightly lower M&A backdrop, we are seeing spreads a bit tighter. But actually, on the direct lending side, we've actually seen them pretty much stabilize, which is interesting, I think, in contrast to the syndicated market where you've seen spreads continue to grind tighter.
You know, I've often struggled with the idea of whether it's good to be in a rising rate environment or a decreasing rate environment. And I'm guessing, like, if you do your job right, it shouldn't matter as long as those changes aren't sudden. Is that how it works?
I think that's right. Again, at New Mountain, we focus on more defensive growth sectors. So these are sectors that are going to perform well regardless of the rate outlook, regardless of the macroeconomic backdrop. So we're definitely trying to solve for companies that are resilient and are not reliant on any particular rate environment for success. But you're right. I think private credit and specifically direct lending is definitely a floating rate product, and we've enjoyed higher rates these last few years. And upcoming, if we see the rates perform like the curve suggests, we'll see that come down a little bit. But over decades, right, as an asset class, we've delivered hundreds of basis points of premium to the risk-free rate, regardless of what that has been.
And to your point, the market has looked healthy, and every now and then you see something that worries people. Matt mentioned one of them moments ago, First Brands. Issues there, Tricolor. I understand that there are like specific fraud issues with that company too. But when you see those pockets, does it signify that maybe lending terms were too easy for some companies, or you see those two and you're like, that's incredibly idiosyncratic and you can't read into it?
Yeah, I mean, I can't comment on specific deals, obviously, but I think just in general, what we're seeing in the direct lending market is that terms still are tighter than they are in the syndicated market. I think that's generally a theme that you see a little bit more looseness in the syndicated market credit agreements, and that's where a lot of these issues, I think, have transpired. That's not to say there aren't risks and issues on the direct lending side, but certainly when looking at our portfolio, we feel like things are holding up pretty well.
What do you see when you look at your portfolio? Where is it focused? Where are the strengths? What makes you so confident in your holdings?
Yeah, I would say two things. One is we are very much sector specialists. So we focus, again, back on those defensive growth sectors, things like enterprise software, tech-enabled business services, infrastructure services that are going to be more resilient. And so the result of that, I think, is we're seeing general stability in the portfolio companies. And we have a private equity business as well. And so we apply that knowledge that we learn as owners and operators of businesses on the private equity side, and we benefit of all that knowledge on the credit side.
I know New Mountain Capital, you all, as well as a lot of people in this industry, are also looking at wealth And increasingly, that also goes to retail in terms of investor bases for private capital. Given that you're in many asset classes, does everything in private capital make sense for a wealth-orientated audience? Is it just credit? How do you think about the mix that makes the most sense for them?
Yeah, not necessarily. I mean, I think there are definitely asset classes that lend themselves better to the wealth channel. You know, we think credit is one of them, not the only one, but one of them, just in the ability to generate consistent enhanced yield for the underlying retail market.
Laura, great having you in. Hope we can get you back again because we love talking about this stuff. Laura Holson there of New Mountain Capital talking about her portfolio and the industry at large. Still ahead, EA is going private after a leveraged buyout shakes up the video game sector. It's the biggest leveraged buyout in history. The Saudis are increasing their hold over this fabled video game maker. This is Open Interest. Electronic Arts is being taken private by a group of investors that includes Silver Lake and Saudi Arabia's Public Investment Fund, as well as Jared Kushner's Affinity Partners. It's the largest leveraged buyout ever. Let's talk about it with Leanna Baker. She's the managing editor for Bloomberg's Deals teams and joins us here at the desk. I mean, this is a banger. I mean, a monster
What
deal.
a way to start a week. What a way to end Q3 for M&A. It's just very exciting for everyone involved and just a huge check. We were just talking about how only sort of the Saudis could be behind like a $50 billion deal. But Silver Lake, which is part of the consortium, they're all over the news. They're involved in the U.S. TikTok deal. We kind of know them for being involved in things like Dell, but now they seem to have branched out into interactive entertainment and internet.
They've gotten a whole new lease on life at Silver Lake.
But doesn't it also just speak to like how much money is out there, how much dry powder these firms have, the fact that they can take private a video game maker for such a punchy sum, there'd be demand to finance that debt, and also an industry there are kind of question marks around right now.
That's probably a reason why companies like EA and video games are going private. It's such a hits-driven business. It costs so much money to make these games. You might have seen the promos for Battlefield 6. You know, it looks like a big movie blockbuster, but it costs a lot more money to produce. We also are seeing JP Morgan funding the deal with a $20 billion financing package. So there's also kind of the old school Wall Street names around this, not just, the Saudis and sponsors like Silver Lake.
So does this mean M&A is coming back, or is this a one-off?
It's clearly come back already. We also saw, another Merger Monday deal over in Europe. Genmab bought a company called Maris, which we broke. That's, $8 billion. So we are starting to see kind of this drumbeat of deals get announced for different reasons. Different industries are consolidating. Video games and biotech are very different, but there's different reasons for companies to get together and have to partner to
It's pretty crazy that we do it now. I mean, especially as the Fed is in a cutting cycle, right? And a lot of people are saying they're going to cut 2 more times through year end, maybe down to 3% is the terminal rate. Does it not matter to these guys where rates are?
So that could be good for lending. There's a lot of debt involved in a lot of these transactions. But there's been sort of a wave of consolidation hitting video games. Activision Blizzard went private 2 years ago. Zynga has been private, that Take-Two bought. So there's not a lot of companies publicly traded. So why not take advantage if there's these pools of capital out there, especially Saudi Arabia. Video games are the new oil for them. That's another thing that's sort of driving this.
That Microsoft Activision deal had so much regulatory scrutiny globally. Is part of a deal of this size coming in also just a bet it's an easier regulatory environment? These types of things, mergers from drug makers to video games, is just going to happen happen with less tension in a Trump
Also, one of the buyers is married to the president's daughter. So, he'll get a pass, right?
So the deal still requires regulatory approval, probably CFIUS approval. This is a foreign investor coming in, but definitely Jared Kushner being involved. People close to the deal are sort of saying, things will be fine in terms of, any scrutiny since he's involved, but, never say never.
All right, so what's next? What are you watching? When you're sitting at the desk, what are you guys excited about?
So as we sort of wrap up Q3 and into Q4, we are thinking of these mega deals. Deals always beget deals. I think there's a lot of pent-up demand for other potential LBOs, strategic acquirers. Can't get into my notepad. I'm sure investors would love to know what we're chasing, but there's certainly a lot of advisors, a lot of dialogue happening. And
one thing we learned recently from Crystal C, which I had not known previously, is that Labor Day weekend is like all hands on deck for the deals team because so much activity happens around that holiday. Does that mean you can chill a little bit until Christmas, or are you still?
So any day the market's closed during the week, that's another day for advisors to, strike a deal where, the stocks don't move around. So yeah, Thanksgiving, we're worried about Christmas, Boxing Day, all these days we're looking for deals to potentially be in the works.
At the same time, Liana, there's been a lot of commentary from different private equity executives saying, it's time to get back to the very classic style of deal making where you need to buy a company and turn around. You can't just financially engineer it. But the fact that there's so much money sloshing around the system and you can do another giant and a record-breaking leverage buyout, does that suggest maybe that's not exactly the case, that there is some room for some kind of financial engineering of deals?
I mean, there could be turnaround. Like once you're private, there's no attention on your earnings, right? So EA, maybe they'll cut costs, maybe they'll just get more efficient. So I think the private equity playbook, isn't lost on these companies going private. That is part of this trend of these mega take privates. What could happen behind the scenes? And these companies can maybe emerge stronger.
Yeah, as Matt and I were talking about before, the number of public companies has halved since the late 90s, so it continues on that trend. Liana, thank you so much for joining us. Always wonderful to have you, Liana Baker there. All right, a quick check on markets this morning. About an hour into your trading day, we're higher by about 0.5% for the S&P as the NASDAQ 100 nears a gain of about 1%. It is the best September since 2013 as yields come in, Matt.
Yeah, yields coming in, stocks moving higher, especially the tech stocks. And cruise lines are having a tougher day, even though Carnival said its earnings will be better. Norwegian has a hot new boat coming in. We're going to talk to the CEO when we come back. I'm sorry. That's okay.
Let's get a look at some single stocks that are moving in this hour. Shares of Alibaba rising, bullish calls from Morningstar, Morgan Stanley, and Jefferies. Analysts say that there's improving growth prospects for the company's cloud and their AI business.
Moonlake shares are sinking after following disappointing late-stage clinical trials on the biopharma company's experimental drug to treat a debilitating skin condition. And wow, you lose 90% of your value in one day. It must have been pretty bad.
Yeah,
bad
I'm
results.
assuming it doesn't have many drugs, and this is probably one of the few. We're also watching defense stocks. There was a report from the Wall Street Journal that the Pentagon is asking missile suppliers to double production rates. It's a tall task for production of missiles that can take up to 2 years to assemble. And Matt, at the same time, they don't have necessarily the money commitment from the Pentagon. The Pentagon is like, just do this, please.
Yeah, so big move across that sector. We're going to talk about defense stocks later in the show. Tim Draper is going to join us. And I want to talk a little bit about cruise lines right now. Norwegian is embarking on its largest new build order in company history as it looks to surpass the competition. Over the past 5 years, the company's stock has lagged behind competitors, Royal Caribbean and Carnival. The industry as a whole has seen demand rebound while costs continue to climb. Joining us now is Harry Sommer, Norwegian Cruise Line's president and CEO. And Harry, we've been talking about cruises for the entire morning now because Carnival came out with better numbers than expected, and yet its stock also traded down. What do you think the problem is? Why isn't the market embracing, better numbers and newer product?
Well, I'm not, first off, nice to be here this morning. Thank you for having me. I'll say I'm not really here to discuss Carnival's earnings.
Of course
but
not.
I think overall, the cruise lines have had a tremendous run-up in stock, us included. I think over the last 3 months, our stock is up the most in the industry, and we're very, very proud of that. Consumer demand is robust. The guests love the guest experience. It reflects a tremendous value and a much better experience than hotels and resorts. And our stock price has seen a run up in the last few months as a result of that.
Well, I mean, the reason I ask about better results is I was just reading in a story that you make more money at Norwegian than any of your competitors in terms of the amount passengers spend on board, right? And that seems to be what investors want. That's what analysts are after. Plus, you have have higher end, newer ships coming out to court the luxury consumer. That also is what we read that people want. And yet your stock, even though you've had a great 3 months, has really underperformed over the longer term. So why aren't investors seeing these products and these results and rewarding you for them?
Listen, we are super passionate about delivering a fantastic onboard guest experience. And I think the spending results you've talked about in terms of onboard revenue are a reflection of the great experience our guests get on board the ship, that we give them things that they value and are willing to pay for. And we're very super excited about that. Listen, I can't talk about, I can't really talk to what happened 6 months ago or a year ago. I'm very happy with what our stocks performed the last 3, 4, 5 months now. Again, outperforming all the other stocks in the industry. And our goal is to continue this run by delivering great experiences to our guests and great financial results to the investment community.
Harry, there's certainly a lot more people going on cruises that maybe didn't in the past. I'd say my parents are among them. They went on one of your luxury competitors who shall not be named on this program. Even so, this question is for them because they looked around and said, hey, everyone is our age or older. Everyone's in their 60s and older. And that's something you hear about cruise operators. What do you do to attract the younger generations? And if you can't, is it a problem down the line for this industry?
I think if you look at the cruise industry, there's really a bifurcation. There are a series of luxury lines, perhaps like the ones that your parents went on. We have 2 luxury lines in our fleet, Oceania Cruises, which is our entry luxury level product, and Regent 7 Sea Cruises, which is our ultra luxury product. It's true in that demographic, these cruises are a little bit more expensive. We do tend to attract an older clientele, but we also have our contemporary brand, Norwegian Cruise Line, where a large percentage of our guests are 40 and younger. We continue to develop amenities, entertainment, activities on board the ship that are relevant to those people, and they're absolutely responding. That the demographic between 35 and say 45 is our fastest growing demographic for that brand right now, and we continue to focus on that so that we can have a new generation of people that will cruise over and over and over again. The repeat rate of these guests are at all-time highs on any given ship. About 45% of our guests are repeat customers, which is one of the reasons we announced our loyalty match program this morning, so people can go between lines and have a great experience, the experience that they deserve.
You have the Oceania, that's the luxury brand that you operate, Allura. It's a new boat coming back from its maiden voyage, I think tomorrow.
Yes.
Tell us what's different, what's new, what are you offering consumers that differentiates this boat from other sort of luxury high-end big cruise lines?
So at Oceania Cruises, we're super passionate about delivering a fantastic guest experience in terms of luxury amenities on board the ship, large cabins and suites, fantastic staff on board and a large staff to guest ratio, so guests feel like they're being pampered at every single moment. Of course, the bedrock of Oceania Cruises is the finest cuisine at sea. We win every culinary award out there, and for this new ship, the Allura, we have upped the game even further. We've reintroduced a French restaurant concept, Jacques, which is extremely popular with our guests. We have a new creperie, which has fantastic sweets, freshly made all day long, crepes, ice cream, and things like that, and pastries. But I mean, super high-end, not the normal fare you would get on a contemporary cruise line. And our guests are enthusiastic about it. We have new shopping on board. We have new experiences in the theater, all the things that our guests value.
And Harry, it goes back to what Matt was saying, that you have this great capture rate of getting guests to spend on the boat itself. But you're talking about some serious luxury offerings. As we were saying, things that are expensive that not everyday people can necessarily afford. You also have more mass premium type offerings too. How does the behavior differ between the more luxury offering and those more mass offerings that you're giving?
Traditionally, on the higher end brand that we have, Regent, which is our ultra luxury, it is all inclusive by nature. So guests are getting, free shore excursions, lots of free things, gratuities are included, on board. So they're not really paying that much extra on that brand. Norwegian is a little bit different. We do have some fantastic bundles that guests can buy into, like 70% off drinks packages that we're running right now, 70% off specialty dining and things along those lines, so that guests can get a deal and enjoy luxury amenities on board our contemporary ship, but it tends to be a little bit more on the onboard spend side than the ticket price on our contemporary brand.
Hey, Harry, this has been great. Thank you so much for joining us. Please come back again soon. Harry Sommer of Norwegian Cruise Lines, ahead of their maiden voyage of the Allura, coming back to the U.S. shores. Okay, coming up on the show, Honeywell making acquisitions to meet the rising global energy demand. We're going to speak to Ken West, CEO of Honeywell Energy and Sustainability Solutions, a conversation you don't want to miss. Coming up next. Demand for energy around the world is rising rapidly. The International Energy Agency reported that global demand rose by 2% just in 2024, faster than the average rate over the past decade. Add to that the AI energy need that we're putting online in 2025, and to meet demands, companies are reacting. Honeywell has made a string of acquisitions to push further into LNG and energy infrastructure. I'm pleased to say joining us now is Ken West, Honeywell Energy and Sustainability Solutions President and CEO. Ken, great to see you. Thanks for joining us this morning. How acute is the energy need right now, and how far away are we from actually meeting that demand?
Well, first, thank you so much for having me. It's a pleasure to be here with you. And you're exactly right. That need that we have for energy is there today, and it's going to be there even further tomorrow. One thing that, as I go around the world and I talk to large energy providers and energy users, that they can agree on is the world will need more power tomorrow than it needs today. In fact, many of the forecasts say that we will need more than 30% more energy by 2050 than we have just today. So that's part of what Honeywell is working behind the scenes to find efficient solutions to meet those needs.
So what are the biggest bottlenecks to getting power? I had an email recently from a viewer who said, these turbines are incredibly hard to get right now. There's a super long waiting list for them. And that's just obviously one piece of one kind of energy generation. So what are the biggest problems, the biggest things holding you back?
Yeah, so when you think about it, energy is created from large infrastructure investments. So one of the things that's holding us back is just the time to be able to bring those up and bring them online. That's one of the things that we've been able to do within Honeywell is, first and foremost, we're optimizing existing infrastructure. So by adding things like automation behind the scenes, we've been able to improve reliability and actually get more power out of the existing infrastructure. In addition to investing in some of the new transition fuels, that some of these have been out for many years, but they're being expanded to meet some of those growing energy needs, such as LNG, and that was part of the acquisition we did from Air Products at the end of last year, bringing on their liquefaction process unit.
Well, from a U.S. regulatory standpoint, this administration has been doing more to try to remove some of the barriers, especially with LNG, expedite some of the authorizations. At the same time, though, some of the renewable energy capabilities and things that would help make that easier have tightened that. How has the regulation push and pull changed business?
Yeah, for us, we're very much a very long cycle business. Many of the technologies that we're providing to meet these needs, we've been working on for decades, and they will continue for the next few decades. As we look, the current administration has removed some of the barriers that were there for getting near-term investments, such as LNG projects, even right here in the United States, where we've seen a number of announcements and recent investment in those areas. And for Honeywell, we continue to stay very balanced, where we're continuing to focus on, one, the optimization of our existing infrastructure out there. Two, the investment in transition fuels such as LNG, where we have an end-to-end solution from process control all the way to pretreatment to liquefaction. And then three, to continuing the proliferation of new technologies that are going to help in the renewable space. So we really feel like the timing has been great for our investments, and we're well positioned for whichever way this goes.
You kind of touched on it, but I'm wondering how AI can help you improve operations and how your subscription-based sales model is working out.
Yeah, so if we take a look, automation has been a key point to our operations. Labor force is continuing to be a challenge. And one of the things we're able to do with these AI capabilities and digitization behind the scenes is augment existing workforce. So we can take somebody who, let's say, was working in a control room, a control board operator in a petrochemical plant or a refinery. Someone today with 2 to 3 years of experience, with the help of some of those tools, they can become and operate with much of the same decision capabilities as someone that used to have 30 or 40 years of experience. So we're augmenting the training, making the workforce more efficient, and being able to do this and improve optimization.
And they pay essentially a salary, like a subscription, right? So it's like, instead of paying a person that bigger salary, a smaller subscription to Honeywell.
Well, they do. So if we think about many of the facilities, we're first on the technology side of developing and building these facilities, but we also help support our customers in running these facilities for the next 30 or 40 years. And this comes with everything from the reloading of things like catalysts and others that are durable resources that are needed in these facilities, to helping out with service and engineering. And that's part of our model. So we've developed and launched a model called Performance Plus, where we take and blend those automation capabilities. We're connected to more than 800 of these process units around the world. And we blend that with our leading service capabilities and engineering capabilities. So when you put an engineer, technical service, and AI together, now we have a great option for our customers with Performance Plus.
Is it enough to completely relieve some of the labor constraints we have right now, marrying the technology together, or is there still an issue there?
It has definitely helped, Dani, in those labor constraints. When we take a look at it, wherever we are in the world, labor is going to continue to be an issue as we go forward, and this is definitely helping to support those.
All right. Great to get you on the program. Really appreciate you stopping by. Ken West there of Honeywell Energy and Sustainability Solutions, talking about the power generation that we really need to power this AI revolution. Coming up, speaking of, the legendary Tim Draper joins us of Draper Associates. He has a new reality TV show. We're going to ask him about that, as well as his Bitcoin and AI investments. This is Bloomberg Open Interest. Startup competition Meet the Drapers is entering its 6th season, with tapings currently underway. The show, hosted by venture capital icon Tim Draper, brings in entrepreneurs from around the world to pitch ideas and compete to win $1 million. Tim is the founder and managing partner of Draper Associates. He comes from a long line of venture capitalists, as well as generals and diplomats and economists. Tim, great to have you on the program. I mentioned that because I want to get into a little bit later how you look at venture capital through the lens of what your family has accomplished throughout generations. But first, on the show, what are you looking for here? Is it the idea that you're interested in, or is it the person pitching that idea that's more important to you?
Oh, the show is so much fun. You know, we're doing a U.S. tour now, and I've just been in Tuscaloosa, Alabama, and I've been in Detroit, Michigan. Now we're doing it in New York, and the show is taking on amazing forms. We've done it mostly internationally. I mean, it reaches hundreds of millions of people worldwide, but the U.S. is relatively untouched so far. But now we're looking for entrepreneurs in the U.S. We think timing is perfect now. The regulatory environment is improving, and we're looking for entrepreneurs from generally high-tech entrepreneurs that are looking to transform very big, lazy, bureaucratic industries. So that's kind of where we're going, and we've got like 1,000 entrepreneurs trying to get on the show for every 4 we put on. And it's fantastic. So it's a very good group, and we end up funding at least one in every season.
And Tim, I know the whole point of this also is spot early trends, find technologies that might not be on the mainstream radar. With that in mind, what are we missing? What isn't on the mainstream radar? Because right now, all the tech money is pretty excited about AI. Is there something else out there that you think the funding dollars should also be flowing to?
Yeah, AI is going to transform all our jobs and all our industries. And that is the general AI companies, you know, they're going to have a big impact on the world. But we're seeing big opportunities in healthcare, where people are going from it's like chemotherapy to biocures. So all this new technology with CRISPR and mRNA and stem cells and cloning, those are really changing the nature of healthcare. And then in space and transportation, space is the final frontier. And it's going to be an amazing frontier, and all sorts of interesting things are happening out in space, from mining asteroids to living on the moon to whatever. And so that's really having a big impact. And with all the military spending around the world now, all of our space and transportation companies are becoming dual use. And then Bitcoin, there's a gravitational pull toward Bitcoin as we transform the banking, commerce, all these industries as we move from fiat to Bitcoin. So I think those are going to be good areas, and AI is going to impact all of them.
I want to get back to your family, because I have interviewed your kids, at least Adam and Jesse, on a number of occasions.
You got to interview the rest of them.
Well, I'd love to interview all of them, but through knowing them, I've heard a lot about, your grandfather helped to redevelop Europe after the Second World War, and your father was the chair of the Export-Import Bank and chaired the UN Development Program. And I wonder if you look at infrastructure investments that need to be done today because of the geopolitical climate, or defense investments that need to be done today, especially in VC, right? We hear about the big names, but are there opportunities there in VC as well?
Well, I like freedom and I like progress. And the best leaders are the ones who set very clear guidelines and then trust their people and set them free. And I think, and I'm also a free trader, and I'm hoping that the geographic borders start to fall again after we get through all the tension. So no, I'm not particularly looking at defense, except that I am looking at opportunities for every industry that is getting a little lazy and where the service does not meet the price. If we're paying a lot for the service and not getting enough for it, I'm looking for technologies and entrepreneurs that are going to go after those industries and wedge in and start providing better service at lower cost. Yep. So I think we've got there are a lot of industries like that, and one is defense, one is big pharma, one is the lawyers, so one is insurance, one is banking. You can think of all government is like providing, not as good service at a very high cost. And I think all of them are ripe for transformation because of artificial intelligence, because of Bitcoin.
Yep. Tim, let me ask you on Bitcoin. We only have 30 seconds left, but we have Michael Saylor on later today. And I've been, covering Bitcoin for over a decade. I remember when you and Adam bought the Dread Pirate Roberts stake from the federal government. How can we be using Bitcoin in all these disintermediating ways and to disrupt banking, for example, if we're not prepared to spend it? And Michael Saylor says, don't you dare spend that Bitcoin. I don't think a lot of people would want to do that today.
No, but there will be a moment when all the retailers start saying, I accept Bitcoin. And then there will be a moment where all the retailers say, I only accept Bitcoin. And I think that'll be the moment where people start to spend Bitcoin.
All right.
I have no intention of selling Bitcoin, but I do have an intention long-term to spend it.
So that's when it becomes transactional. Tim, looking forward to the 6th season of your program. Thanks so much for joining us. Tim Draper there of Draper Associates, and they will record that program today. Meet the Drapers. I'm going to go see it live.
Very cool. Coming to the U.S. I think they were in India in one of the past seasons. So come bringing it home. All right, I'm going to check on markets this morning, about an hour and a half into your trading day. We're up by 0.4%. The NASDAQ outperforms up 0.8%. Coming up tomorrow, Keith Lerner of Truist, David Kostin of Goldman Sachs, and Shinola CEO, and David Crawford of Bain & Company.